Having only just fired the starting gun for the official launch of the UK's EU referendum on the 23rd of June, the markets have been positioning now for some time. But what's at stake for equities? So we're talking now to James Ross, Henderson UK Equity Fund Manager, who co-manages the Henderson UK Alpha Fund. James, welcome.
Hi.
As a fund manager, does the prospect fill you with dread?
It doesn't fill me with dread per se, but it's certainly an event that we're keeping a really close eye on. And it's an event that will clearly, and already is, impacting equity markets, FX markets, the UK economy. So it's something that's hugely important to us.
Well, what are the dynamics then that are going on at the moment ahead of we're 9 weeks away now?
Yeah, we're a long way away, but already we're seeing dynamics in the market reflecting positioning around remain or leave. The main things that we're seeing year to date are effectively a sharp reversal of what we've seen over the last 3-4 years. And the last 3 to 4 years we've seen domestic focused businesses doing very well, and we've generally seen mid-cap companies doing quite a bit better than large cap companies. That's completely reversed year to date. So we're seeing large cap companies doing very well, and there are several reasons for that, some related to this Brexit referendum. But we're also seeing domestics really getting hit quite badly.
What is it then that's giving the positive boot up the backside of some of these big cap companies that have suffered so much? What is it about Brexit that investors in those stocks like so much?
Firstly, it's people are nervous, and nervousness generally creates a tendency for investors to move towards large liquid names. That's certainly been a factor. But if I highlight 3 sectors that are doing very well year to date, 3 large cap sectors, hopefully this will show this theme. So the 3 sectors I highlight would be commodities, so basic resources, oil and gas, and consumer staples. Now, the things those businesses have in common is that they're very little domestic focus, but they're hugely involved in the rest of the world, in global trade. And so if people are nervous about the potential for a Brexit at the referendum, then they don't want to own domestic focused businesses. They've been buying those businesses that are exposed to overseas. There's also obviously been other factors at play. The flattening yield curve that we're seeing has helped staples, and oil and hard commodities rallying has helped the miners and the oil companies. But large cap so far this year is really where it's at.
In terms of the investor appetite for risk, generally speaking, are you finding on the whole that you're being asked to hold more cash than you would otherwise normally hold in the fund? Are investors preferring to pull back a little bit and stay on the sidelines, generally? I
think in general there's a fair level of nervousness. The way that we play the situation is that I'm not going to hold in my fund 10% or 12% cash. Different funds treat cash in different ways, but for us we hold enough so that we can take advantage of opportunities that we see in front of us, but other than that we'll remain pretty fully invested.
And is your cash level at the moment higher than it would normally be at this time of the year?
So it's very marginally higher. So we're at 5 to 6% cash, and we'd usually be 4 to 5. So it's at the margin, but hopefully we get an opportunity to deploy some of that cash in some of our most favoured positions.
Okay, so what are you going to be doing now? As I say, the 9 weeks we've got until this lead up, and there'll be more of these sort of interviews and more of rhetoric around this from politicians and so forth. What are you going to be doing?
Yeah, the noise will only increase for the next 9 weeks, we're all aware. In terms of positioning around the event, we tend to buy companies that we like, that we believe we can hold for 2 or 3 years. So positioning around an event that I think personally is very hard to call the result of is not something we're going to do in any large way. So really what we're looking to do is find sectors that we like, find companies that we already like, and if we feel that they're being unjustly sold off because of concerns around the domestic economy or Brexit concerns, then we'll try and pick them up. And good examples of that would be house builders. So house builders are a sector we like the dividend growth profile they're generating at the moment. We like the returns on capital those businesses can generate in a very benign land market, and those are getting hit quite hard. So hopefully we'll get an opportunity to buy some of those. And then mid-cap banks is another area that we really like. So some of the challenger banks, we own a position in Paragon, we own a position in Aldermore, and if we see further weakness in those, we'll look to pick some up.
Okay, let's wind the clock forward to the 24th of June, the day after, and when we all wake up and presumably we'll have the result, or certainly when we get the result. Let's just assume that we remain in. And I guess to some degree the status quo will remain in that instance. What do you then do?
I think if we remain in, I think we're likely to see a bounce back in some of these domestic focused businesses.
So the FTSE 250 companies?
Yes, absolutely. I think the mid-cap would outperform large cap. I think we'll see a reversal of what we've seen year to date. And so in that situation, we will be very keen to add to positions that we already like, already have in the fund, but are focused on the mid-cap and focused on the domestic economy.
sectors particularly?
Yeah, again, I'd highlight those banks. So I think the classic domestic sectors would be the banks, which we'd definitely be keen to add to because we like those, the house builders as well. Sectors that are quite domestically focused that we aren't so keen on and wouldn't be adding to would be the retailers. We believe they have a number of issues, and we wouldn't be adding exposure there, but we would take the opportunity to add to the banks.
Okay, let's switch that then and say we wake up and we're out. David Cameron's gone. Boris Johnson looks set to take over. Politics aside, where do you go as a fund manager when you're looking at the big unknown?
Yeah, well, there certainly would be an instant reaction in the stock market, and we've seen part of that already, and we will see a very violent reaction in my belief if we do end up leaving. That itself will create opportunities. So it's actually very unlikely that I will be suddenly buying a different type of company to that which I preferred before the referendum, a different type of sector. It's very unlikely that I'll be looking for new opportunities, but unfortunately I'm going to get a way better opportunity to carry on buying the things I already own. So really, to hammer home the point, we're always going to invest behind the companies we like and the businesses that we like, the sectors that we like. That's not going to change if we exit the EU, but we'll get better opportunities at lower prices to buy more of them.
Okay, well, it's all up for discussion, and hopefully we'll have you back the closer we get to the vote. But James, in the meantime, thanks indeed there for joining us. James Ross is Henderson UK Equity Fund Manager, co-manages the Henderson UK Alpha Fund.